Ladies and gentlemen, fellow traders, friends, welcome to the live show. Here we are again, live on Thursday at 12 on my side in Africa. Don't know what time it is there by you, or we'll see. But today, I'm going to break down the cold, hard truth about trading. What most traders try to learn in 3 years actually takes decades. And there's a lot to understand about trading that most people just never catch on to. And one of those things is, well, charts don't make you money. And that's really important to understand. I've got 34 years in the market, so I've learned a lot in that time. And let me tell you something, those first 10 years, those were the most difficult times. Those were tricky because while I made money and everything was fine, and I thought I knew everything about the markets, just like most traders do, and I thought that charts made you money and everything was easy, I need to find out and realize suddenly that actually charts don't make you money at all. It's completely the opposite. It's completely something else. We will discuss some fundamentals today. SLA did ask me about fundamentals. And fundamentals are important to understand. Yesterday, you were all hanging your hats on the NFP data. I know this. You were all sitting there waiting for those jobs figures to come out. And the jobs figures come out and the markets run in a direction and you all get excited. And then it goes the other way. And then at the end of the day, everything looks like it did to start with. I'm going to move my picture out of the way. But just remember, guys, trading is risky. Most traders do lose money. And if you don't like losing money, you probably shouldn't be trading. Let me just move my picture out of the way, and then we'll take it from there. If I can ever get onto my picture to move it out the way. There we go. Make it nice and small so that I'm nice and small and not big and in the way. And we can go and have a look at some charts, and we can have a look at a few other things on the day as well. This is just the New Zealand dollar, US dollar that we were looking at today. And it seems to have bounced to the upside rather than going to the downside as I expected it to. Somebody asked me in the comments, hi, I am Blue Mango, good to see you, fantastic to see you again. Somebody mentioned to me that, well, the US dollar Japanese yen trade went really, really well. Well done on that, but they said you didn't mention the great British pound US dollar. And I'm really not sure even which way I called it the other day. But all I can say is whatever the scenario here, right, I didn't take the trade, but I should have, because I probably called it long, probably called it a buy because it broke through this trend resistance and it's come down a little bit. Oh dear, that happens sometimes. Do you know why? Because the market's 50-50. But has it gone crashing down? Certainly not. And I would still be in the trade because at the end of the day, my stop loss would be down here. My take profit would be up there. This is a long-term trade. This isn't something you don't trade for 5 seconds. You have to be patient in the markets. I see there's a lot of zero patience in the markets, and that's one of the big things that we're going to talk about today. It's insane to think that so many people are so impatient, and they just can never, ever get around it. You have to wait for things to happen. On the US dollar Japanese yen, I've moved my stop loss all the way down. Quite far down, actually. It almost took it out again. The other day, was it yesterday, when it shot up here, my stop loss was just up here. It almost touched my stop loss and it came down. And in profit, obviously, there's a few good few bucks in profit there. And now it went back up again after I've moved my stop loss down to follow it and almost took it out again. It would have been a fair profit, no problem. It's in profit as it stands at the moment. But if it keeps on going down, that's also great. That's fantastic. What I want to talk to you guys today about is the expensive, brutal lessons that I learned over the years that many of you will probably take years to come across. Most traders actually make the same mistakes. Hi, Beverly. Good to see you. You got to understand that most traders will do the same things over and over again, and it repeats itself over and over again. New traders get into the market, and they always make the same mistakes. We do the same things over and over again. We dollar cost average when we're losing. We try to revenge trade. We try to move our stop losses away. It's coffee with Ron. The same psychological mistakes every single time. One of the big things is you guys with the NFP, with the news. This is the most amazing thing. I'm just going to change this over so you can see. Everybody would have been sitting waiting for these figures on a constant basis. And yesterday, a lot of you would have been sitting waiting for the NFP figures, just hanging your hats on it and hoping that it's going to do something in your favor, or you'll understand the market in one way or another. And some of you will say, well, I knew it was going to go long, or I knew it was going to go short. But if I take you back to the S&P 500, and we go and have a look at the S&P 500, what are we going to find? We're going to find that it's done absolutely nothing. It's done nothing. It's pretty much where it was before the NFP figures came out. Now, why is that? Why is that so important to understand? We've got charts. We know there's a resistance. We know there's a support. We've put that on the daily levels. We look at this and we think, well, after the figures, it'll either have broken up or it would have broken down. I mean, that's what everybody thinks. And if the figures are good, like they were, surprise, surprise, the figures were good. That was quite a surprise, right? But everyone said, if the figures come out good, we're going to go long. We're going to buy. Everything's going to go well. Everything's going to go great. And it shoots up a little bit, and everybody jumps into the market. They get sucked in. Oh, we got you. You're buying. And then it goes down. And you think, what? What's going on now? And someone will talk, and they'll come up with some ridiculous excuse as to why it's now suddenly going down. And then at the end of the day, it'll settle back where it started, and you'll think, how did that all happen? What went wrong? What actually happened? Well, I spent years, many years, in those first 10 years of my trading career particularly, watching the news, hanging my hat on non-farm payroll, CPI data, jobs figures, and these types of things, thinking that this is possibly what moves the economy. But actually, that's not true. Actually, the economy moves them, moves those figures. So what's actually happening in the background is there's a huge reserve of money, and they either print more money or they don't. And if they print more money, it becomes more worthless, by the way. But that money gets moved around and gets shifted around, and it pays for things, and it runs the country just like you would run your business. So when that money moves around and shifts around, everything changes. And once you start to understand that there's money flow moving around and things are happening, businesses are either profitable or they're not, you start to figure out that, wait a minute, it's not just about a little jobs figure that comes out today. All that jobs figure does, for example, is it gives you an indication of how the country might be doing as far as employment goes. And, you know, when you've lived in a country like South Africa or Africa, for example, where you see them declaring 38% unemployment like it's not even an issue, and we know that it's more than 50%, perhaps even 60% unemployment if you take into consideration all those people that are not on the roster, that are not there. We live in a country with nearly 60 million people. Correct me if I'm wrong, I probably am. But only 7 million people are paying tax, which means only 7 million people are actually properly employed. You work out the percentages on that one. Now, I get it, there'll be a lot of informal employment and a lot of the other things going on, but these are things that don't change how companies make money. Companies are making money regardless, and a 2% change in employment is not going to change the profit margin of a retail store down the road in all likelihood. A huge sum of unemployment, that might change things. So in America, you guys are sitting on 4% unemployment. If you guys go over 5%, then you normally declare a national disaster, to be fair. So 4% unemployment. If that goes to 3%, is that going to change everything? It's going to give you an idea or a direction maybe, but it's not going to change everything. So in that time, the one thing I learned is that these charts, these little charts that we're looking at here, they don't change things. They don't predict the future. They can't really tell you where the market's going. They can give you a way to manage your trade and an entry point. So you're looking for entry points. You're thinking, where am I going to enter into this? The US dollar, Japanese yen went down. Why did we get into that? Because it broke a structure. It broke the structure. It looked like it was going down, and we took the trade. That's as simple as it gets. I'm not going into detail and moving average crossovers, MACDs, volume profiles, average true range, Fibonacci, Ichimoku, or any of these other fancy systems and indicators that you all talk about, which you think predict the future. They don't. They do not predict the future. The cold hard truth is that every single time you take a trade, you have a 50% chance of winning. You also have a 50% chance of losing. And the cold hard truth of it is, you're going to lose more trades than you win most of the time, most of you. Why do you think that you're going to come into a market brand new? You've only been doing this for a few days, a few weeks, a few months, or even a year. But you're going to beat institutional traders, which make up 95% of the market, by the way, who studied at school, who learned all about markets and money. They know far more about money than I'll ever know, even though I've been doing this for a long time. They know absolutely, they study these things. Yet you come in and you say, I'm going to trade and I'm going to take their money. I'm going to jump onto the tail and I'm going to take their money. I'm going to try and make some money from this particular situation. Why do you think that? Why do you think that you can take $100,000, $10,000, $1,000 and double it in 12 months by just trading in the stock market? What gives you that inclination that you can actually do that? This is where you all go wrong, is you're actually trying to do something that's not really in the realms of normality. You're expecting something that actually isn't there, a magic pill that's going to come out the sky. And this is where it all goes pear-shaped. So what normally happens is we get charts, we expect that every single trade we take is going to go in our favor, just like this one has, and we're going to make loads and loads and loads of money. But we forget about the Great British Pound trade, which one of the commenters mentioned, that didn't actually work out. It's going a little bit against us. But the trick is, as I always tell you guys, to make more on your wins and make less on your losses. So in other words, if you've got, well, how many is here? 1, 2, 3, 4, 5, that's 10, 15, 16, 17, 18, 9. I can't really divide 19 by 2, but let's say you've got 18 blocks here, 18 different products to choose from. And you trade all 18 of them. Buy, sell, buy, sell, buy, sell, whichever way. Doesn't even matter what the charts say. You just jump in and you buy and sell all of them. You'll probably lose 9 of them, if not more. But let's say you lose 9 at $1,000 a trade, and you must keep your risk the same on every single trade. Don't change your risk, because then you really don't know what your costs are. You don't know what you're going to be losing at the end of the day. And if you lose those 9 trades, you're going to lose $9,000, and that's a huge sum of money, and you're going to be in shock, and you're going to be, if you've only got $10,000, you're in big trouble. But you've lost $9,000 on those 9 trades. But let's say you win the other 9 trades, and you make more on your wins than you would on your losses. In other words, you make more than $1,000 on every single one of those trades. Now, what I can tell you is that in general, on every single one of those trades, some of them you're going to make 1-to-1. Some of them you're going to make 6-to-1. Some of them you're probably going to make 2-to-1, 4-to-1. But on average, if you work it out, most of the time, you're going to come out of the other end with a risk to reward ratio of approximately 2-to-1 normally, usually. It's interesting, but that's how it works out. And if you do come out with a risk to reward ratio of 2-to-1, the other 9 trades are going to make you 18,000, which means you'll finish that 18 block trading session with a $9,000 profit. But the mistakes you're all going to make is you're going to try and make that profit in 2 hours, or you're going to try and trade on 5-minute charts, or you're going to try and trade on 1-minute charts, 1-second charts, because you're all impatient. You all can't wait for trades to come to you. You've got to wait for trades to come to you, and that's so important. You've got to wait for trades to come to you. You can't force the trades. Now, sitting watching 4-hour charts or day charts or anything to that effect, when you're trading Forex or crypto or indexes or commodities, it doesn't matter what you're trading. It's like watching paint dry. Nobody can do that. I can't do that. I can't sit and look at charts all day. That's why I make YouTube videos. They keep me busy. And before I did YouTube, I had other businesses on the side that kept me busy. And if I didn't have other things on the go, then I'd probably play games. But at the end of the day, you can't sit and watch charts all day. So what some people will do is they'll drop to the 5-minute chart because they're bored and they want to make money quickly. That's a big thing. When you've only got $1,000 and you're desperate to make money, then the quickest way you can think of making money is dropping to the 5-minute charts. So you drop to the 5-minute charts like this and you say, well, I'll trade on the 5-minute charts and I'll make a profit here. Believe me, I've done this and successfully done this. It is possible to make money on the 5-minute charts, but every little bit of information you get on the 5-minute charts is incredibly unreliable. It's not good information. So you've got the same odds. Take a trade, you've got a 50% chance of winning. But 99% of traders lose on 5-minute charts, mainly because of the fear, mainly because of the psychology, mainly because you can't get around the psychology of 5-minute trading. There's very few that have the hardness to do 5-minute trading. And then you have the other issue, the issue that keeps me away from 5-minute trading, and that is sitting watching charts. You're going to be sitting watching charts. So some people say to me, all right, Rob, you know what? We're not going to sit and watch charts all day. We're going to come in for 2 hours. So we're going to come in at open. We're going to trade for 2 hours on that 5-minute chart. And then what we're going to do after that 2 hours is after we've made $200, we're going to go home with that profit, maybe $2,000. I don't know what kind of size trades you're making, but let's just say $200. And then we're going to go home and we're going to relax on our $200, or we're going to go to the beach or whatever. I get that. But what always happens is you come in for those 2 hours and you lose $400 rather than making $200. So now you've got a dilemma. Do you stay for the rest of the day and try and get that money back, which you won't? Or do you come back tomorrow and try and sort it out? But tomorrow, you don't have to make $200 anymore. Firstly, you've got to make today's $200, tomorrow's $200. That's $400 plus the $400 you lost. So now you've suddenly, instead of making $200 in that 2 hours, you have to now make $800. Work that out exponentially, how bad that's getting. And then if you go to the third day with a similar scenario, it's just out of the ballpark. You're losing all your money. That's the cold, hard truth of trading. Most people lose. Most people don't make the money. Trading isn't about indicators. Trading isn't about predictions. It's not even about luck. Trading is about understanding how to strategize your trades, how to make the trades work for you. So if you take a trade and you say, I want to go short here. The stop loss was up here. The first thing you do is you look at where you want your stop loss. And then you say, I'm going to risk $1,000 on this trade, on all of my trades, on every single trade on this account. That's my risk. In some cases, it's 1%. Some cases, it's 2%. Depends on the type of trader you are. If you're starting out with a very low amount of money, very small amount of money, like $1,000 or $10,000, you might want to risk 10% or 20% of your account. But understand that when you do this, there's an insanely high chance that you're going to lose it all. So if it's the last money you've got on earth, be very cautious. Be very careful, because if it's your last money on earth, you're going to struggle more than a normal person that's only using a portion of their money to trade with. If you're using all of your money to trade, there's a good chance that the fear is going to take over in your head and it's going to mess you up and you're going to lose all that money. So the smaller amount of money that you've got, the more difficult it becomes to trade, and you're probably going to want to risk more and you're probably going to lose it quicker. That's generally where it goes. That's the cold hard truth of trading. Trading takes your money. Markets are not there just, markets are not sitting there going, oh, come and fetch all our money. They're sitting there waiting for you. It's going to take you a long time to get the feel. You see, the thing is, it's not only about the strategy I give you. It's also about getting a feel for when to buy, when to sell, is it good, is it bad, and understanding that although you're going to take losses, you're going to make wins as well. And the wins are the things that are going to make you the money at the end of the day. So now you've risked $1,000 in every trade, so you risk $1,000. So now you look at where you can put your stop loss, and then all you do is you work out the size of your trade from that $1,000 back to the cost. Once you've worked out the size of your trade back to that, you just work out if you can make a profit on that trade. For example, will I be able to make a profit on that trade? And will it be more than my risk? Because anyone who risks more than what they're planning to earn is insane. They're just insane. Why would you do that? Why would you risk more than what you're actually planning to earn? That doesn't make any sense. Look at gold here. You see, gold is lying against the resistance. So let's say you decided, I want to go short on that. So you would have a situation where you put your risk above the prior high maybe, or maybe above those prior highs. And you say, okay, that's my risk. My risk is $834 on this, and it's close to $1,000. And that puts my stop loss at 5,482 on gold. And if it really gets there, then it's really gone. Perhaps I should actually bring that down a bit, because I mean, I'm really looking at an insane stop loss. Let's look at 5,300. Goes past that, I'm most certainly going to be in the wrong side of the trade. And then say, I want my take profit, at least my first take profit down here, which gives me a reward of more than what I'm taking a loss on. I'm risking 800 and I'm losing 1,200 here. Or maybe down to here, I can make at least 2 to 1, $2,000 on a take profit of a level down there. That's how you work out your trades. If you want this thing, a few people have asked me for this, and it's called Position Size Calculator Gadget. For those of you who are trading on MT5, you get it on the MQL over there. You can go and fetch it, and it's free. It's totally free. So that works for you. If you're on Trading View, that's actually quite easy, because then every time you click a trade, you can choose your stop loss, you can choose your profit, and you can work out how much you're going to make. The thing is, you have to understand that you're going to take losses in the market, no matter what you do. You can't call the bottom of a market. This is another thing that I get all the time. So many people come to me and say, you can just buy when it hits the bottom. I want to see any one of you call the bottom of a market or the top, and then at that point, put your money in, put all your money in, throw everything at it, and say, well, it's at the bottom of the market now. I'm going to put all my money in here, and I'm going to make loads and loads and loads of money from it. I don't think any one of you can do that. I don't think anyone's got the courage to actually do that, unless they're a gambler of some sort, something to that effect. You can't call the bottom. You see, it looks like you can, and you take all the indicators and say this market's at the bottom, but there is never that top and there is never that bottom. And when it does get there, you start to question yourself as well. You start to question, because now you're ready to put all the money in. You all the indicators are there that you've worked out and that say to you, do you know what? This is the bottom. But then you start to question that. You start to think, well, this is all my money. Should I? Is this really the bottom? And how much further can it go? The market can remain solvent much longer than you can. Believe me, that's a fact of life. You are not going to remain solvent as long as the market can. In any event, I will now take questions on that if you are interested in asking questions with regards to that scenario on how to trade. The important thing is to understand that the charts are not making you the money. At the end of the day, The strategy is the only thing that's going to make you money. You see, the aha moment came to me a long time ago when everybody kept telling me, Rob, you can only make money with time in the market. And I thought, if that's the case, how do traders make money? The only way that traders can make money is by applying that time in the market to, do you know what? Just make more on your wins. Because that's sort of the same as kind of like just putting things in the market and leaving them there. Hope that kind of clears up some issues in the market, but it won't clear up all of them. Let's see who's here today. Let's talk, let's chat, ha ha. Okay. Coffee with no sugar. I put some honey in it today. I cheated. 4-hour chart is the way to go. Absolutely. Hello, Lane. Good to see you again. There's 5-minute time frame below. You have to be watching the charts all of the time. I tried it. I'm back in the 4-hour, so I can ideally watch it until I can move my stop loss to break even. You know, the biggest thing, Kevin, on the 5-minute charts is not only that you have to watch it all day, is that the information that you get on each individual candle, each little candle here, is very, very poor. So the information that you're taking from these candles is ridiculously poor. And because imagine how many candles you're going to put into a 4-hour chart. You know, I haven't really worked it out, but you know, you can put quite a number of candles into that 4-hour chart, and that thing's moving up and down. So the information you're getting there is basically insanely poor based on that. So when I traded 5-minute charts, what I would do is always look at the higher time frames, day, that sort of thing, see which way the market's moving, and try and move with the market. That was more successful than anything else. And morning, Kevin, by the way. Just making your coffee now, yeah. So yeah, that's important to understand as well. So for example, if I take this down to a 5-minute chart, suddenly you've got a completely different picture here. Okay, so if you looked at this now, you'd think, wow, that's coming down. It might go long, it might go back up. If I take it to the day chart, I know that it's at the moment, it is kind of bearish with a bit of a bullish tinge to it. H4, it's kind of got a bit of a bullish tinge to it. It's breaking out, breaking to the upside. This could be going long. So on the 5-minute chart, which way is it going? Difficult to say, isn't it? So yeah, I'd rather trade on the 4-hour. It's actually better for me, better for everyone. S&P 500 is a big shocker considering yesterday's NFPs doing nothing, doing absolutely nothing, not moving at all. And everybody expected big moves from this. And there you go, standing still again. So it's really struggling to get through that 7,000. Will it come back before it goes up? I don't know. I don't have a crystal ball. I wish I had a crystal ball. I wish I could tell the future and tell everybody what's going to happen next. But nobody can tell you what's going to happen next. It's near impossible. You just have to look at the possibilities and the probabilities. And why would you take a trade at any given time? Today I looked at New Zealand dollar, US dollar, probability. It's reached this area here at the top when it's just milling around here. So this is probably a reasonable short trade. Because it's milling around up here, because it's just milling about and saying, I'm at the top. So you could look at it and say, I'll just take a short trade on that. But then you need some kind of confirmation to take the trade. And there isn't much at the moment. This will probably come down and take some money here, bounce around. Is it going to go anywhere? I don't know. I'd like to see it come down to these levels down here. You know, you got to look at things for what they are. Bitcoin, everyone was calling this to go back up over the weekend. And I said this thing's targeting 37,000, head and shoulders on the day. If you guys haven't started looking at patterns yet, if you haven't started working out patterns yet, download it off Google, download a pattern page with all the patterns on it, flag patterns, cup and handles, head and shoulders, all these different patterns, and just study them. It's a few seconds, just figure it out. I don't use all of the patterns. I just recognize the important ones, and head and shoulders is a really important one because when you start seeing them all over the market, there's indications that things might go pear-shaped. And I mean, if you look at this on the day chart, I've shown you this already. I mean, it's a huge head and shoulders, and it's playing out. It's broken below that line, below its headline. So it's moving to the downside. And if you project that down, it projects down to 38,000. So if it plays out, it's quite a serious one. And a lot of people don't believe in patterns, but I tell you, I've seen these patterns play out, and I'm starting to see this one play out because came down, started to go back up. Everyone's getting excited that it's going back up. Crypto's going back up. Poof, it starts coming down again. And now if you start looking at other factors like this resistance line, that resistance line, it's starting to look like it's starting to come down again. Now, I haven't moved the resistance and support lines from previous. So it broke through the support line, it's broken down, it's gone back up to retest, hasn't even quite reached the full retest, it's coming down. There's a good chance this is going all the way down. So we shall see what happens with crypto. It is interesting that crypto is taking quite a big knock. And the other interesting thing is, and this is something for traders to think about, like I was talking today about what actually takes decades to learn, what takes decades to figure out. What you can't learn in 3 years is that feeling in the market, that knowledge that you've got in the market. And the one thing I know is that if the S&P 500 was to fall 50%, 40%, 45%, there would be a world disaster. It would be a world-ending event if the S&P dropped from 7,000 to 3,500 in 3 months. But that's exactly what's happened to Bitcoin. Bitcoin's gone from 125,000 down to 59,000. That's 50%. Back up and down again. And it's going to go further. But on Bitcoin, everybody says, just buy it. It's going to go to whatever. Just keep on buying it. Just keep on buying it. It's a form of insanity. If that happened to the S&P 500, you would all be running around screaming with your hands in the air going, the world's ending. The world's over. It's all done. So you've got to get a feeling for these things in the market. That's that for me is just crazy. Good morning, Rob. I have 2 difficulties working on the 4-hour charts. Stop losses are huge, and my stop losses were mostly hit. What's the technique to place a proper stop loss? Do you use the fib? I don't use the fib anymore. I've used every indicator under the sun. Well, when I say everyone, then somebody will probably come up with one that I've never used before. But okay, Fibonacci I have used. I do like the Fibonacci because it does play nicely into support and resistance. And if you want to use it, that's great. Very much the most important thing about the fib is to look at its golden area between the 50%, 61.8. That golden area is really important. But do I use the fib? It makes no... You see, that's the thing. I've got to the point in years of trading that indicators mean nothing to me. Indicators don't tell me much. The reason I draw a line like this is because this is how I started. I started by drawing a line many years ago before there was computers. We had a piece of paper. I just used to draw a line. If it was above the line, I bought. If it was below the line, I sold. Simple, eh? And then later on, it was easy to draw resistance and support in on the computer, and it became much easier to trade. But I got sucked in when computers came around to all these indicators and all these fancy indicator things coming along and different systems. And I got sucked into it all, Wyckoff and all these different things. And I started to believe in charts. I started to believe in candles. When I started trading, I didn't even think of charts as something like that. I used to know that there was another trader selling when I was buying. I understood that. But for some other reason, it just washed out of my brain, went away, just disappeared. And I just only started to see these little red and green things and candles and stuff on the screen and think, oh, I'm trading against that now. It took years for me to go back and to realize that we don't want to be doing that, and there isn't a system that makes you money. It was at that point when I realized that you can't, if you can't do time in the market, you've got to find another way to make money, and charts don't make you money. It was at that point that I kind of realized that I got to go back to basics. I got to go back to where I started, and that is just drawing a line and drawing a couple of lines in, checking where the trend is, above the line, below the line sort of scenario. And I made it simple and kept it simple. And that's why I don't bother that much with fib anymore. If you want to know something about fib, I can show you fib. But yeah, I just don't bother trading with it, because every trade you take, every single trade you take, no matter what your system, no matter what you think your edge is, it's going to be a 50-50 trade. There's going to be a chance of it winning and a chance of it losing. And I know that when you take the trade, you're obviously taking it with 100% thought that it's going to win, because otherwise, why would you take it? You're not taking it with a thought, oh, it's definitely going to lose. You're taking it with a thought that it's going to win. But the idea is, make sure that you cover your risk on every trade in the knowledge that you're taking a trade based on a system that you're using, whether it be fib or whether it be support and resistance, whatever the case. And just work it out with that. Let me see if I can get the Fibonacci in here. Let's put a fib in here. So you would have your fib. This is not the nicest fib, is it? I can hardly see it. Maybe if I made it yellow, it would be better. Don't know if it will. Can't even get the damn thing. See if I can get it here. Maybe I can make it yellow and then we'll be able to see the damn thing. It's like ridiculous at the moment. No, it only does that. It's never going to work for me, is it? Damn thing. Levels, there we go. Dark green, yellow, there we go. Now you can see where everything is. All right. Terrible fib, that. But anyway, so here's your fib. Top to bottom, this is oil, okay? So at the moment, you're right at the top here, and you got to wait for it to come down to the golden area, which is between 50 and 61.8. You're going to look for a buy here, and you're going to go up. So you're going to have to be very patient on this particular trade. For example, if you were going to take it, come all the way down to the bottom here before you take the trade, unless you take it off the 23 or you take it off the 38. So that's the fib. It does line up with our trading, but in my trading, I'll be much simpler. I'll wait for it to get down to the support level, take a trade off the support level with a green candle and go up. If the risk to reward is good, all you've got to look out for is the risk to reward. How's the risk to reward? Am I going to make more reward than I'm going to take risk? That's the best way to do it. Okay. Oh, yes, let me go into detail on the stop loss. You did ask me about the stop loss, and then I went off on a tangent on something else. So how you take the trade is this, okay? So let's say you wanted to go long on oil. Let's say this is the trade for you, okay? So you say, I want to take a long trade. Now I'm going to use this so it just makes it easy for you. First thing you do is you look at where your risk's going to be, okay? So your risk is going to be below the prior low, below the support line, okay? So you've got your risk. Now, the important thing is to understand that you must risk the same on every single trade on any particular account. So if you decide on that account, I'm going to risk $1,000 per trade, whether it's 10% of your money or 1% of your money, doesn't matter to me. For me, it's better if you do 1%, because then if you lose 10 trades, you only lose 10% of your account. But the important thing to understand on a 4-hour chart is you take an account, whatever size it is, and you decide every single trade that I take has the same risk size. Because the minute you change your risk size because you feel better about that trade and worse about that trade, it's going to go pear-shaped and it's not going to work out for you. You're going to end up losing more than you win. You want to win more than you lose. On 4-hour charts, it's not that you choose a set loss amount. So if you've only got $10,000 and you only want to risk $100 per trade, that's fine. If you want to risk $1,000 per trade, that's fine. But make the decision, stick with the decision, same for every trade, okay? First thing you do is look, where do I want to put my risk? I want to put my risk in this area, below the prior low, below the support. I know if it gets there, I'm wrong. That's what's the important thing. When am I wrong? Because the important thing is not to move the stop loss. And the important thing is not to try and dollar cost average it, because that's not going to work out for you in any scenario. Some of them will come right, but it's a relief trade and you'll get to zero and you go, phew, I got my money back. Isn't that nice? But then all you want to do, you're planning your trade, is you go, let's see how much reward I can make on this trade. If I put my risk at 66,428, which in all, I mean, come on, we're buying it at 69,345. If it gets to 66.5, surely this trade is invalid. In fact, you could put the stop loss even closer if you wanted to. But there you go. You've decided that's my risk, $1,000, 66,428. If it gets to that point, I'm out of here. That's it. Trade's gone. I'm losing $1,000. But if I win, I'm targeting $2,178. That tells me I'm on a 2-to-1, which is a pretty good risk to reward. Even if it was 1-to-1, it would be a good risk to reward. But if I'm 2-to-1, even better. Now I'm targeting that area. Now the big thing here is, your question was, oh, it's quite far back now. I have two difficulties working on 4-hour charts. Stop losses are huge, and my stop losses were mostly hit. What's the technique to place proper stop loss? Okay, let me answer the question correctly. The technique to place the proper stop loss, okay? Because when you say huge, maybe you're going into news events and it's spiking you out. The technique is to put your stop loss below areas where you feel like there's just no way, if the price gets there, it's over. Now, if I look at this, for example, we're putting the stop loss down here, right? We're putting the stop loss down at this level here. You can clearly see it's below the support. So if it breaks below the support, what is it? It's short, right? If it breaks below the support, that trade's gone. It's going down. Also, now, next thing is, if it breaks below the prior low, even more short. In fact, if it breaks below that level, you could put the stop loss down there. That's just like, this trade is dead, okay? That's how you choose your stop loss. Point is, keep the amount the same. So you're just going to have, the bigger you make your stop loss, the smaller your profit's going to be. Let me show you that. So, for example, did we say we're going long? Okay, so the problem here is your reward's up there, right? Okay, so if your stop loss is there, your reward's like $6,000, okay? If your stop loss is there, your reward's $2,000. But if you put your stop loss further down, your reward's $1,500, okay? That's kind of how you're setting up for your trade. It just, the more you move your stop loss, the smaller your reward gets. You want to keep your stop loss in an area where you know if the price gets there, it's not going to work. And you want to put your stop loss in an area where you know it's not just going to get taken out for absolutely no reason whatsoever. So generally, if your stop losses are getting taken out, they're too close. They're too close. You may think it's a big stop loss, but it's too close. It's probably in the area where it's still a valid trade. If it's taking out your stop loss and just flying on, then your stop loss was in the right place and it's just continuing on going, then obviously your stop loss was in the right place, not the wrong place. So be careful of that as well. If you're getting your stop loss in a situation where it takes your stop loss out and it keeps on going, in that event, you're looking at a scenario, for example, let's say you were long on this trade, not short, and it came down and took your stop loss out here, and then it kept on doing this, then you win. That's not a problem. That's what stop loss is for, okay? The problem you've got is if you, for example, went long on this trade here, okay? And you put your stop loss where the price is now, it comes down, takes your stop loss out, and you think, oh, damn, and then it goes long like this and goes all the way to the top. It means your stop loss was too close and it was in the wrong place, okay? It needed to be in a different spot. That's all that means. I normally put my stop losses behind the resistances, behind the supports, behind the prior highs, that type of thing, and that's what normally works for me. Okay, that question was quite far back. I use what you do, Rob, like support resistance trend lines, MAs in the area, and that makes more than enough for my chart. I don't wait for them all to line up, but it gives me something to watch for. No indicators will tell you exactly what to do, but it will give you a bit of structure. I'll always take a trade assuming it will lose. Hate Diet Pepsi. I will always take a trade assuming it will lose. What Hate Diet Pepsi means by that, I'm pretty sure, is the same as what I mean. Is if I take a trade, I understand that I'm going to lose trades. I understand that if I take a loss, that I need to manage that loss, and I understand what each trade is costing me, which is why I love trades like this. For example, when I took this trade, I understood that it's going to cost me $1,000, and now it's costing me nothing. In fact, it's going to make me $1,000. So I'm happy with that. Perfect, no problem. Okay, right. Hi, Tyrell. Good to see you. Thanks from Kevin. Thanks. If stop losses are huge, I'll switch to checking out an option trade. Option trades, you still got the option, and you've still got to work out your stop loss, and you've got to work out your option. So you're still in the same boat. Is that a day frame? No, it's a 4 hour. We're working on 4 hour charts, but we run on the day frames as well. 4 hour. When do you move stop loss to break even? Sometimes I move it too soon. Good question, Beverly. When do I move stop loss to break even? So let's say, I wonder if I can move that to its area. Okay. So there's your trade. Okay. So your stop loss is up there, maybe. Okay. And your take profits down there, maybe. And this is not exactly how it's played out, but okay, I'm just using this as an example. Okay. Now the profit starts moving down. Okay. So you're getting this profit down here. So let's say, I'm going to leave that there. So let's say your profit is down here at around $500. Okay. And you're targeting, a couple of thousand, whatever the case, or just over 1,000. This is the time to move your stop loss because you're in profit. You take your stop loss and you move it down into these levels. And then it keeps on moving. And it starts getting really close to target. This is the time when you really want to take your stop loss and actually just move it right down to levels that are right down close by so that you can actually make some money. So it's a question of just bringing it in. You've got to get a feel for it. It's like I said earlier on, what most traders try to learn in 3 years takes decades, okay? This is a gut feeling that you've got to have. So you've got to see, look, my trade starts there, it moves into profit, and I can see it's in a nice clean profit here. So I want to take my stop loss, move it down, not only into cost, maybe into a slight profit, saying, do you know what? This trade's now free. It's not costing me anything anymore, so it's free. And then it keeps on going, which is nice. And then you can move the stop loss even further down into profit. And then it keeps on going, which is even nicer. You can move it down even further into profit. I could actually take my take profit and move it further out now if I wanted to. Doesn't really matter. Depends how I feel about the trade, because I'm looking at the trade and it seems to be kind of losing steam. So I'm in two minds as to whether I want to move my take profit out or just let it take it out, or what's it going to do? Is it going to continue on? Yeah, those are the questions you've got to ask yourself. It's a bit of a gut feeling. I might still end up moving that trade a little bit further out and seeing what happens. But yeah, as it stands, it's moving down. It's consolidating, and this is normally a sign that it'll resolve to the downside. So maybe we should move the take profit a little bit further down. But just give yourself that gap. When you see, if you're targeting 1,000, you see yourself $500 in profit, move it down to cost. And then if you see it moving even further, move the stop loss even further. Just keep moving it, following it down. That's the best way to do it. Probably the only way to do it. Okay. The Bitcoin is trying to come back again. That's important. US dollar, Canadian dollar. There we go. That is bouncing as well. Boom, boom, boom. Way late on login to your stream. Hello, Daniel. Long time no see. Good to see you, bud. Daniel's been a long-standing viewer of the channel. Been around for a long, long time. And Daniel was here, I think, before I even had 1,000 subscribers back in the day. So it's really good to see you again. Lovely stuff. The option loss is your stop loss. Hi, everybody, new and from past. Wow, 3 ads already. Oh, 3 ads already. That's great. I'm getting paid, man. Yeah, no. Gosh. It's actually funny. People don't understand. You know, when you get paid for stuff, it's like, who works for free, man? That's great. Yeah, no, absolutely. US 30 going up. There we go. That's lovely. Big, big, big move to the upside. Broke out of its range, moving to the upside. It's actually quite interesting because I see this moving up. I see it stalling a bit. But the S&P 500 is actually just hanging about. It's not making that move. There is a big shoot back up here, but it's just hanging around this area. It's worrying me a little bit as far as long goes. You know, I'm thinking, well, it's good for the VIX, isn't it? Share my thoughts on gold. I shall do that. Rob taught me to have a 100% green week. 1 to 2 trades a day with wins in all of them. Love that, Daniel. Here's gold. Now, what do you know about gold? What do you understand about gold? Now, remember what I said to you at the beginning of this video. Most traders try to learn in 3 years what actually takes decades. I spent decades in the markets. Have some more coffee. Decades in the markets watching gold. And there used to be this guy in South Africa, his name was Clive Roffey. He used to talk about gold all the time. Man, I hope he's still alive. He's quite old. And his big thing was gold is going to go to the moon one day. And it was, those days, it was like $600, $800 all the time. Because like I told you guys in one of my videos, I mean, I used to sit, I didn't have YouTube and that sort of thing. So I used to sit and watch the experts on TV. I used to sit and watch the institutional traders would come on TV and they would talk about shares and they'd talk about what to buy and what to sell. And every night they would tell me time in the market and I'd go insane. But I wanted to trade. But anyway, Clive Roffey was always on those shows as well. He was always on those shows and he was always talking about gold and he was always calling for gold to go long and do well. And eventually, it took a long time and eventually found its way to $2,000 a few years back. It sat there for a long time as well. And then suddenly it just, boof, shot up. And the first person I thought about was him. I was thinking, wow, that oak's been waiting for gold to do that forever. But you know, my opinion on gold in general overall, and I'll get to the analysis in a minute, but my opinion on gold overall is if I'm going to invest in something, I'd rather invest in shares. So for example, for the long term, if I'm putting money away for the long term, I would much rather buy a bunch of shares, set and forget, leave the money in those companies, and in 30 years, I'm going to be mega wealthy from it, okay? Whereas, and if you were to look back on the S&P over the last 100 years, you would see what I'm talking about. If you go back 100 years and you come to where you are now, if you'd invested a few dollars back then, you'd be multi-millionaire now. That's the S&P. Whereas with gold and commodities, it doesn't work like that. And the reason it doesn't work like that is because commodities are cyclical. What do I mean by that? They go up, and they go down, and they go up, and they go down, and they go up, and they go down. They don't go up in one direction. Although let me put this on the day. Let me make it a little bit smaller. And yeah, it certainly does look like gold is just going in one direction, doesn't it? Looks like it's just going up. But if you just go back to this point here, where it was at 1,800 or 2,000, and follow that all the way back, you'll see it didn't go anywhere. So this has only all happened in the recent times. Okay? So now, let's make that a little bit bigger again. Go back to H4 and do some analysis on gold. Now that you understand a little bit more about gold, you understand a little bit more about commodities. Gold used to be tied to the dollar. In other words, people used to have a situation where the dollar was tethered to the gold. In other words, the value of the dollar had a lot to do with the gold in the reserve. It was untethered in the 70s. And that really doesn't matter, though, because you value a country's currency based on the asset value of the country, not just the gold. But when it was tethered to the gold, it was helpful. Gold is on its own now. Gold's got its own value. Now, a lot of people talk about holding gold in the event of the world ending or whatever the case. And that's what goes through the psychology of people with gold. Ooh, I'm going to buy gold because there's going to be a world war or something like that. Not realizing that it costs an absolute fortune in fees to actually buy physical gold. And then you have to keep it and store it and keep it safe, make sure no one jumps into your house and runs off with it, and even though it's quite heavy. And then if you want to sell it, it costs you an absolute fortune to sell it again. So if gold is worth $5,000, I mean, you're going to have to pay $6,000 to buy an ounce. And if you want to sell it, you're going to get $4,000 for it, kind of thing. That's kind of where it goes. I'm not sure the exact fee. I'm just using that as an example. But anyway, whereas on the market like this, you can actually buy and sell it like the S&P 500 for a matter of $1, which is great. That makes all the difference. But if you're a trader and you're trading it just like crypto, because crypto is fresh air. Crypto's got no asset value. If you buy crypto, you're buying against another trader, basically. At least with gold, you're buying on the asset value. Now, why do institutional traders buy gold if this is the case, if gold is cyclical? Why do institutional traders get into these markets? Well, it's really simple, really. An institutional trader or institutions have a situation where they work with people's money, they work with pension funds, they work with savings accounts and all these types of things, banks, all that sort of stuff. Now, they can't keep cash because cash can't give their clients the 10% that they're promising them, or the 8%, or 5%, or 0.5%, depending how stingy they are, or if they're Uncle Scrooge, or I don't know, maybe they're a generous bank and they give you more. I don't know. But this is the whole reason why they say if you invest money with them, they want you to have a fixed deposit, or they'll give you much less for an open account, savings account. Because if your money is fixed, then they can work with these products and there's time in the market. So what they do is they say, well, we can't have more than 5% cash at any one time. 95% of the money needs to be invested at all times. So what you'll see happening is they're looking at, for example, the S&P 500 or the shares or the market or whatever, and thinking, this might go down. And there's things happening in the market that might cause it to go down. They've got all the information that you and I don't have. They know what's happening next, and the president's saying this, and there's a bit of geopolitics going on over here. That affects their psyche, and they think, well, you know what we need to do? We need to take some of that money that's all invested in these shares and these indexes, and we need to move it into gold because it's a safe haven. It's a good place to put it. So they start putting it in commodities just to keep it safe, because gold is more solid, more of a thing. It's not going to go anywhere. So they invest in gold, and they take it out of those companies that might crash down to the bottom, like banks or whatever the case. And that's why gold moves up and down, moves around, or is cyclical. So at the moment, gold becoming expensive kind of also points to possibilities. I noticed in the last year or two that gold seems to be going the same way as the indexes, and everybody's excited to buy gold. It seems to be a trend. Anyway, let's get down to the simple analysis, and that is this. I've drawn a resistance line in here, which is green. I've drawn a support line in there, which is red. I got that from the day chart. Why did I get that from the day chart? You go to the day chart, you start looking around on the day chart, you pick up the highs and you pick up the lows, okay? I could put the support all the way down here, but the possibility of it getting all the way down there and then in time in the near future is probably zero. So it's more likely to hit these levels here where it's found some happiness, let's say. Like it's the weekly chart. Hopefully the weekly chart will give us a bit more information. Let's see what we got on the weekly chart. Not much there either. Effectively, what you're sitting with gold is you're sitting with a product that's just run straight up, which makes it much more difficult to actually analyze. So what I've done here is I've drawn my own form of a resistance in. There's a touch there, touch there, touch there, touch there. There's more than 3 touches. Does look like an area of interest. And I've drawn in a support, which is an area of interest. It's at the top of that resistance at the moment. What I'm waiting for on gold is, okay, if you take this and you draw it like that, just on the short term, if it breaks through that support, it's going short. If it breaks through that resistance, it's going long. At the moment, there's no call. No call. No call whatsoever. This is a bit of a pennant as well. It came all the way down. It's come back up. It's a bit of a relief rally. A bit of a dead cat bounce maybe. So it's bounced off that support, come back up to the middle here. Good chance it could fall down again. So what I'm waiting for on gold, to keep the analysis more simple, is if this breaks through this little support here, then it's gone, it's going short. And just basically, if it breaks through that little resistance at the top, it's probably going to go long. You can put longer trends in if you want to. Not necessarily, but you're going to wait a lot longer for something to happen, obviously. So that's not really going to be what you're looking for. You're looking for the short-term trend. You're looking for what's going to happen today. So take the most recent low and then just see what it looks like to the top, see if it's going to break through or not. And you actually want 3 touches, but when you're trying to do this, you're just trying to get a direction for the market and see which way it's actually going. It looks to me like there's a good chance that it could come down, but you have to wait and see. There's no guarantees with this sort of thing. You could also do the Fibonacci thing again. You could draw the Fibonacci in. You probably find the golden zone somewhere down here in the middle. See if it's going to get to that and bounce back up, that sort of thing. You could use supply and demand, that sort of stuff. I just draw the lines in. I have a look at which way it looks like it might go, and I just take it from there. That's my analysis on gold anyway. I've gone into quite a lot of detail about gold, just by the way. Okay, where were we? Okay. I've shared my thoughts on gold. Watch Rob's older videos. Great info to teach your mind to handle the stress of trading. Do that. Watch my older videos. Although hopefully my newer videos are better than my older videos, but go and watch my older videos because I did give a lot of good information in those older videos. Hello, fellow traders. Second time here. Welcome, Ronnie. Good to see you again. Hit that button to support Rob's channel there. Don't forget to hit the like button. How many likes have I got? Have I got any? I don't know. You guys tell me. I'm long on the DAX. Yeah, let's have a look at the DAX. DAX. There we go. Good long. Looking nice. Let's take it to the day on the DAX and just see what we've got here. You see it's breaking out of that level, but I just want to see on the DAX what levels we're sitting with here. Yeah, it's a pretty good level. Pretty nice. I don't know why I always end up with these things on this Lumen thing. It always quite annoying. I'll take that one out as well while I'm here. Hopefully I can. There. Okay. Now, back to H4. Take it back up again. Yeah, the DAX looks like a nice, reasonable trade. No complaints there. Looks like it's broken to the upside. Looks like it's moving. Yeah. Just remember on the DAX. I do love the DAX. But just remember on the DAX that it will follow the other markets. So keep that in mind. US dollars at AR. I'll never understand why why the rand keeps getting stronger apart from the US dollar weakening, but it keeps on going, keeps on going, keeps on going. I mean, South Africa's sitting with an economy that's ridiculously bad, but that just keeps on going. And then oil, my favorite, still struggling to move up. Euro, Great British Pound. There we go. Couple of undecided candles there. Okay. Gold is in the distribution range now. Kevin Simpson, keep that stop. Looking for the NASDAQ March futures to reach around 25.5 today. No long yet, waiting for the New York stocks to retest 25.3. NASDAQ. I'll tell you what, on the NASDAQ, what did I see there? Yes, that's exactly what I saw there. I drew this trend, just make it a little bit more sort of solid there, okay? Trend resistance on the NASDAQ in the area. There's a resistance, there's a support. It's come all the way down, didn't reach the bottom, bounced back up. Bit of a bounce here. But what I did notice is, and I don't want to draw an extra line in, but I'll draw it in and take it out, is a bit of a double top sort of scenario developing here. And there seems to be a lot of interest in this area, which could be a bit of an issue when it comes down to it. And then this trend resistance is kind of filtering into it as well. So if you're going to go long, you want to be waiting for it to break that and break to the upside, I would suggest. If you're going to go short, obviously you want to see a red candle dropping to the downside. But at the moment, it's still bearish. It's not confirmed that it wants to go up yet. If I look at the day chart, similar scenario, not much confirming that it's going up just yet. It's sort of consolidated in this range. And this range has actually moved up a little bit now. You can actually move that up to there. It's kind of consolidated into this range. It's sitting here in this range. It hasn't jumped out of it yet. But if it breaks to the upside on that trend resistance, then you might get a good long trade there. You know, but it needs to actually break to the upside or give a red candle to the downside. These candles are very small, tiny. It's like very undecided, very, well, sleeping market as well. It hasn't opened yet. Okay. What else have we got? UK 100. This is the surprising one. Everyone tells me how the UK is doomed, and this thing just keeps going up. I haven't actually drawn the lines in here recently, but let me see what we got. Okay, so on the... yeah, that's pretty much it. It's broken out, broken to the upside, come back, retested, and gone up on the day chart. Looks like it might come down a little bit again. If you want to just confirm that, you can just put a trend line in to give you a bit of confirmation as to which way it's going. These trend lines are very, very, very handy for just checking which way the market's going, that's all. It helps you a lot. You can use it in your RSI as well if you use RSI to trade with. If you're an RSI trader, you can use it in your RSI. I think I have shown you that before. If you go to gold here, okay, let's say you want to use an RSI. Let's say you want to add an RSI in here. Change colors again. There's your RSI. Okay. You want to know which way gold's going to go. You wait for it to get out of these levels and then you determine which way it's traveling. So if you wanted to know that it's breaking to the downside, what you would have done is you would have drawn a trend line through here and you would have seen it broke that trend line on the RSI. It was bearish. It broke all the way down. And then on the way back up, you would have seen that it broke the level back to the upside and moved to the upside again. Similar scenario. Now it's in the middle, so now you don't really know which way it's going to go if you use the RSI. Okay. So you can use trend lines on the RSI as well. It's actually quite helpful. quite useful to your trading. Works, really does work. Okay, now, keep that stop loss moving up as you lock in profits. If it hits your stop loss and move higher, sell at it, you won. Exactly, Dale. My stop loss is just following up, just tucked under the support area. Okay. So probably no prediction as the market is fluid, unpredictable due to market news that can screw things up. So, okay, so it's 50-50 going. Best. Yes, I've been watching the UK 100 and waiting for it to drop. Then I'll go in for the buy, but not yet. The UK 100 like really is interesting because it just keeps on going up, and everyone keeps telling me that they're in such big trouble. But I just keep looking at the markets. The markets tell me a story, and they tell me that everything's just fine. Everything is just going up and up and up and up. But yeah, look, I've drawn that little line in there. Let's see if it breaks through that. Then it'll probably come down to lower levels, and then you can buy again. It'll go up. See how that goes. I was actually saying Japan 225 short earlier. I was actually looking at it as a short because if you look at this on the Jap 225, it's just been going along in this trend. Now you are going against the trend. Just remember, you're going against the trend, but you're going against the trend in such a way that, you know, it's in that channel. So there's a chance it'll come to the bottom of the channel and you can buy again and go long. You can always wait for it to get to the bottom and go long as well. But it looks like a decent run. So, you know, I was actually thinking Nikkei short down to this level here. It probably will get there. Just that you had this big run here and this big spike and it came back. I was trying to get back again, probably come down. So the Nikkei looks like more short than long at the moment, even though it's very bullish and very strong as it stands at the moment. Okay. I've been following the NASDAQ price action for many years. I'm very good at predicting where likely it'll go. Oh, hey, no, Pepsi. Okay. So you're predicting a long on the NASDAQ. You see, the thing with S&P 500, NASDAQ, and the like is for the last number of years, you could just buy it, forget it, and it'll keep going up. It just keeps on going up. It'll keep on making you the money. And it hasn't crashed quite a while now, good couple of years. So, yeah, calling it, it's the same as calling anything really. At the moment, it's kind of gone into this range and it's running between the two. Like I said, it'll probably resolve to the upside because that's what they do. They resolve to the upside generally. And it's just a question of when. It's just a question of when and how. I don't think it's, unless we have a major disaster of some nature, I don't think it's going to drop below these levels, 24,000 levels. I doubt that. I do believe it'll probably go up in the long run. You know, your best bet on these indexes, on the US indexes, is long at the moment. But we have had a good run, so you do have to keep in mind that there's always the possibility of something going wrong. Always. But we shall see. See how that goes. S&P 500. The big difficulty is the S&P 500 is just not doing what we want it to. I'm going to delete this. It's just annoying. Maybe just draw a short one in here so we can see effectively where we are. And if the S&P 500 drops, then we'll know as well. Use it on that basis. I'm waiting for it to break through that green line. Give us an upside. That'll be a goodie. And we know the S&P 500 is moving up. If the NASDAQ moves up, the S&P 500 will move up as well. And I'm quite happy if the NASDAQ moves up because I've got in my investments a lot of technical shares. So I'm happy with that. Okay. Daily chart down, trend line is around 25.50. Daily chart. That was NASDAQ. Yeah. Daily chart. Okay. Put it back on H4. Yeah. Pretty much. Interesting. Okay. We'll see what happens with the NASDAQ, see what happens with the S&P 500. It should actually go long, because if you look at how good and how excited everyone was yesterday about the non-farm payrolls and that, it's kind of weird that everything's collapsing again. But yeah, it should go long. And then if you look at the Dow, that's shot to the upside. That's broken to the upside. Looks like it wants to go up, but it's just milling around here as well. It's kind of strange. US dollar, Canadian dollar. The big head and shoulders on the day. You know, these head and shoulders, I've noted them on these two, the Bitcoin and the US dollar, Canadian dollar. There's a lot more of them in the market. There's a heck of a lot more of them in the market here. There's on number of these shares. If you have a look at them, there's head and shoulders hanging around. So just keep your eyes on that, and don't let it slip through your fingers. I did not take the long on the Great British Pound. Probably should have, but didn't. But it is still a good long. It is still a good long. Looks pretty decent. There is an obscure head and shoulders on this as well. Oh my goodness. I'm seeing them everywhere at the moment. It's like a nightmare. Go to bed, see head and shoulders. Anyway, there's a shoulder, there's a head, there's a shoulder. Can you believe it? I actually never saw that until now. I just drew that in. There's a perfect skew of head and shoulders there. So that could play out as well, because if that plays out, this is going down quite far. Let me just have a look at the Euro US dollar while we're here. Euro US, oh my goodness. Euro US dollar's got one as well. Look at that. Wow. Okay. Yeah, there's a shoulder, there's a head, there's a shoulder. So that's interesting. That's really interesting. Okay. Who would have thought? We'll see. They don't always play out, by the way. As I've told you, if it breaks the head, the shoulder to the upside, then it negates it. It's that's quite interesting to see those head and shoulders there. Oops. US dollar index. Oh, okay. Why have I got skew lines here? Yeah, that's broken through, gone down. That's changed direction, and it's on its way down now, so we don't need these lines in here. You never have too many lines in your chart, because it's just going to confuse the issue. You really don't want to do that. Now, this is just milling. Okay. Looks a bit weak. Have you had any luck previously with moving average crossover strategies? I have used moving average crossover strategies many times for many years, okay? And what you have to understand about the moving average crossover strategy is it's a lagging indicator. In other words, what happens with a moving average crossover strategy is by the time it's crossed over, the event has already happened, so your win is a small bit in the middle here. So for example, on this US dollar Japanese yen trade, I take the trade up here and I get this entire win down to this level down here. If I'd waited for the moving average crossover, it would have happened a bit later in the trade, and I probably would have get out a bit later as well. So it just gives you less of a win. That's all. But does it work? Yes. Understand this about the markets. Every single system in the market works. They all work. Some genius backtested it, some genius invented it, and some genius made it work. They wouldn't put it out there if it didn't work. It worked for someone, and it worked for a lot of people in all likelihood. So believe me, it does work. You know, at the end of the day, the biggest moving average crossover ever is the 200-day moving average with a 50-day moving average. In other words, 50-day moving average crosses through the 200, it's a death cross. And when the 50-day moving average moves through the 200 to the upside, that's the golden cross. Okay, those are for big time trades, and I use it sometimes in my investments when I'm looking at an investment and I'm looking at buying into something. If that 50-day moving average has crossed through the 200-day moving average, that share is good. And I'm just looking at general overall information. I was trading on the 8 and 20. At some stage, I was trading on the 9 and 20, and then I changed it to the 8 and 20. Don't ask me why. It was a whole bunch of jargon that got into my head, and I thought I was being clever. Like I said to you, I've traded on most of these indicator systems. And you can use MACD as well, by the way. MACD is very similar to using the moving average crossover system. And that'll also give you a pretty good indication as to which way you're going, but it takes up space on your chart. But yes, a moving average crossover, I believe the best one that worked for me was the 8 and 20. And it did okay. It did okay. When you catch them right, it did okay. But you're not going to win every trade. It's still 50-50. You're going to have a 50% chance of winning and losing. And getting out of your trades, yeah, same sort of thing. You wait for it to cross back. It works. It works, yes. You can use it. Nothing wrong. All the systems work. I mean, I've used Ichimoku before. It works. MACD, stochastic trading, RSI, Fibonacci. The most popular one among the pros is RSI, Relative Strength Index, sometimes with a bit of volume profile. Because relative strength, what they do is they simply buy when it's overbought and oversold, and simply sell when it's overbought. That's how the pros work with it. But the thing with RSI for a retail trader is it can remain overbought for a long period of time while the price is dropping, or it can remain oversold for a long period of time while the price is dropping, for example. So you get in when it's oversold and it just keeps on dropping, and you've got to have deep pockets, because effectively what the pro traders would be doing with an RSI, for example, is they buy it when it's oversold, knowing that they've got plenty of money to cover while it stays oversold, and eventually it'll start to come back. But sometimes when the RSI does come back, the price doesn't come back all the way to where you need it to come back to. So it's not a perfect system as well, just like moving average crossover. It's not a perfect system, but it will work, and it does work. Make no mistake. So if you want to use the moving average crossover strategy, by all means, use it. It can work for you. There are other strategies with moving average as well. For example, on the 20-day moving average, if it's above the 20-day moving average, you buy it. And if it's below the 20-day moving average, you sell it. There's that as well. There's all kinds of strategies that you can use. What you've got to know about charting, all right? Charts don't make you money. Charts don't predict the future. What are you doing when you're charting? You're drawing a line in the sand and saying, I'm going to buy it above that line. I'm going to sell it below that line, because it happens a number of times. Because this always happens, you see? So you've seen it happen a number of times. You've seen it happen before. And every time you see like this line, you see it hits that line and goes down, hits that line, goes down, hits that line, goes down. So your brain tells you, well, every time it hits that line, I'm going to sell it. And the reason it's hitting that line and going down is because there's money in that area, there's orders in that area, and that's what's causing it to go down in the first place. And there's a whole bunch of other like-minded people thinking when it hits that line, I'm going to sell it. So everybody sells it at that point. That's what charts do. So if you're using a FIB, moving average crossover, MACD, any kind of system, RSI, whatever, a lot of other people will be using the same system, like-minded people, and you're basically drawing a line in the sand for yourself to take a trade. It tells you that's your plan. If that hits that point, then I'm going to buy it. And if it hits that point, then I'm going to sell it. And then I'm going to manage my trade. That's the important part. The part that I spoke to you about in the beginning of this video, when this video started, and we spoke about why most traders don't need to learn that after 3 years it's not enough. You've still got decades of learning to go. That whole bit, right? So you know, it's not as simple as just charts are going to make you money. Charts don't make you money. You need that strategy. You need that business plan. It's the cold hard truth of trading that no matter what system you use, they all work. But here's the thing, and this is going to drive you insane. You're going to try taking 5 different systems and putting them on your market, okay? And try looking at the same trade you want to take now on those 5 different systems. And then try taking a trade. There's a good chance that you're going to want to buy it with one system and you're going to want to sell it with the other system, and it's going to stop you from taking the trade. Because you're going to look at it and think, well, if I look at that, that's a buy. And then you're going to look at the other system and say, oh, no, actually it's a sell. You look at the other, oh, no, actually, I shouldn't take the trade at all. You know, that's the problem with all these systems. And that's why you get no 2 traders will actually agree, because, you know, the 2 traders, one will have one system, another one's got another system, and you're both going to do 2 different things. Because one believes it's going to go long and the other one believes it's going to go short. It's not because one of them is stupid. It's because both of them have different systems. They're both very clever people. They're just doing something different. That's all it is. When you get that around your head, okay, when you figure that out and you go, oh, wait a minute, if 2 traders have got 2 different systems and one's saying buy and one's saying sell, what's going on? Is one of the systems rubbish? No, it just means they both have systems that work differently. They have different lines, different points of the chart where they're going to buy and sell and make money. That's what it means, okay? And once you get that around your head, then you suddenly realize, well, wait a minute, then the market's 50-50. Every time I take a trade, I could lose. And every time I take a trade, I could win. How do I get around that with Rob's strategy that I give to you guys on a regular basis in the business plan? It's so easy. Just keep your risk the same and make more on your wins. Forget about the charts are not going to make you a profit. They can't predict the future. If charts could predict the future and everybody was trading on those charts the same old way, everybody was on the charts like, oh, we're going to predict the future now, the market would be flat. And do you know why the market would be flat? The same reason the world would be flat. But anyway, is because everyone would be doing the same thing. Imagine if everyone was doing the same thing. Everyone buys, everyone sells, or everyone holds. Then you're not going to get curves like this, are you? You're not going to get moves in the market. So that's why I say every single system works, because the systems don't make you money. What the systems do for you is they allow you to manage your trade. They give you that feeling like, okay, if it hits that line, I'm going to sell it. And then I'm going to sell this and I'm going to make a profit down to that line there. And some other Joe will be going, well, I've got this system and it tells me I'm going to buy it. So in other words, when I sell it, he's going to buy it, because that's how markets work. Markets are made up that way, of buy and sell. You see, when you're investing and you're buying shares, that's different, because you're looking at a company, you're saying, I want to buy that company because that company is going to be worth an absolute fortune in 10 years' time. And I know I'm going to make money from it because it's Coca-Cola, for example. You know, I know I'm going to make money from it. It started out today, and in 10 years' time, it's going to be worth a fortune. So I go and buy it, and I hold it forever. That's totally different to trading, because now you're buying an asset value product. You're buying into a company. You're buying shares into that company from somebody in that company or from that company. What you're doing on your trading on these brokerage accounts, CFD accounts, futures accounts, is you're trading against other traders with other traders. And a lot of those people are institutional pro traders. They're not just pie in the sky people. Keep that in mind. Try and follow the money. Try and understand you just want to make more on your wins, lose less on your losses. Don't try and beat the market. You're not going to beat the market. This is what I've been trying to tell you guys today. I've been doing this for 34 years. And I learned a long time ago, you don't beat the market. You don't. Trading isn't about indicators. Trading isn't about predictions. Trading is about a strategy of making money, making a profit. I don't know any traders who don't want to make a profit in any which way or the other. I don't know any traders that wouldn't be out there to take a risk and start a business or do this or do that. Any good traders are out there or reduce the fear in their mind and get out there and do things. They're go-getters. They're people that go out there and get things done. So you should be able to figure this out quite easily. So yeah, that's my feeling on any indicator, moving average, crossover, and those types of scenarios. Interesting stuff, isn't it? So guys, on that note, I'm going to head on my way. I think I've gone through quite a lot of the questions. As Daniel said, the Rand is an anomaly. It's an anomaly. Yeah, trying to say anomaly. Anyway, I hope you guys are going to make lots of money. I hope it's going to work out well for you. It's an interesting time. It looks like everything's going to settle down and the world is going to come back to normal. So on that note, thanks for watching, and I'll be back for live shows next week. For those of you who are members, you're going to get the trade of the day in the morning, so I'll see you in the morning for the members area. And there'll be another video coming out on Friday, another great video for you guys, and another one possibly on Monday. I'll see about the live show next Tuesday. I have had some difficulties with people in hospital and stuff that I've been running around with, so I have to see how that's going to work out because it takes up a bit of my time. So I had to sort of do away with the Tuesday live show for now, just until such time as that all settles down and I have a little bit more time for that. Although I do have a lot of time for myself, it's also difficult to handle those types of scenarios and do that live show as well. So I've reduced that. But guys, thanks for watching. Don't forget to like this video because you're all here. Don't forget to subscribe, stay on it. And if you've got any questions, feel free to ask and I shall try and reply as best as possible. Cheers. Ciao.